Do you know that emotional capital is the most difficult type of capital for a trader to accumulate? If you want to learn how to manage your trading emotions with discipline and a plan, you definitely have to hang around for this next presentation. Hi, I'm Philip Teo, your host for Trading World Summit, and I'm excited to introduce to you Mark Ritchie, our presenter for this session. Mark is a professional stock and commodities trader. He is currently the chairman of RTM3 LLC and the managing member of RTM Capital Advisors. The private pool that Mark manages has compounded returns of greater than 40% since inception, with much lower volatility than the general market. Besides being featured in the book Momentum Masters, Mark also consults with Minervini Private Assets, where he educates traders on how to properly find and trade US growth stocks. Now, with this short introduction, it's my honor to welcome our summit speaker for this session, Mark Ritchie too. Hey, Mark, welcome to Trading World Summit.
Philip, happy to be here. Thanks for having me.
Great. So nice. It's really a privilege to have you on board the summit to actually share with us the strategy that you use personally to manage your emotional capital in the markets. Now, for the benefit of those summit participants who might not know you before this, can you briefly walk us through on your personal trading journey? How did it all start for you, and what were some of the determining factors that you think help you become a proficient and profitable trader that you are today?
Great question. Well, some people may be familiar, but I kind of come, I guess, from a trading family. However, I have a number of uncles and my father who were floor traders at the Chicago Board of Trade, most predominantly in the 1970s and 80s, which is well before my time. However, they still were, involved in the markets in one way or the other. I wasn't really that interested, to be honest. Growing up, I didn't really know anything about markets. Certainly didn't know anything about trading in pits, other than your dad goes to the city and yells and screams at other people, and swaps orders, that kind of stuff. But really, I was kind of coming out of college. I studied philosophy at university, which that's a whole nother, I guess, part of my journey. I use that at least in terms of critical thinking, but I don't have a regular, say, part of my process that's linked to that. And then was just sort of between careers. I thought I was headed in one direction, and, sparing the details there, just decided, well, maybe I'll try something else. I had done a little bit of work for a former, I guess he wasn't really a money manager, but he was a trader who had worked for my father at one point, old family friend. And then he just sort of called me up in 2007 and said, if you're not doing anything, would you like to come, see what I do, and then maybe come to work for me? Long story short, that really ended quite poorly, but I wound up working for him for over 2 years.
Wow. Mark, I just want to hold you there for a moment. So you mentioned that you came from a family of traders, including your father, who was actually profiled in Jack Swagger's Market Wizards book, and that's how he became really famous. And it's really surprising that you weren't even interested in trading all the way until college, or even until you go to work and before you need somebody who was working for your dad. So can you share a little bit more? Did your father actually try to influence you to do trading throughout your entire childhood to your teenagers years? Or was it something like a rebellious kind of, I just want to do what my father did, and that's the reason why you actually exclude yourself from the trading?
Yeah, really good question. I think my dad was he was more retired by the time, at least myself. I'm one of 5 siblings, and I'm the only one who's in speculation or trading at all. So my other siblings have gone on to do other successful things, but yeah, I just didn't have any interest. It wasn't a rebellious thing. There was one point, this is in probably the late 90s when I was in high school, when the online trading accounts, those types of things, E-Trade was really getting popular in the United States. And I remember my dad and my brothers kind of tinkering around with it for a summer, and I just had no interest. It wasn't Yeah, I guess, you know, when you're 16, 7, I was probably 16 then, you know, you don't even think about what are you going to do when you're in your mid 20s or your mid 30s. So I just, yeah, no real interest. And then it was just more of I kind of got the bug by working for somebody else. And then I would ask my dad occasional questions. The funny thing too, though, is what I do now and how I manage money is completely different really from what he was doing. But, you know, and I can get into at least part of my upbringing that I think has had I mean, there's a number of things my dad's taught me that's had a huge amount of influence on me, positively, of course. But it wasn't like he took me under his wing, taught me his strategy, and then I went from there. So, I mean, the biggest thing, you know, that we did a lot in our house and that my dad was really big on was playing games and solving puzzles or thinking about things in that way. And I do think that playing games of probability, playing games of chance is a really good backdrop for trading. And that was something that I always enjoyed and that I was pretty good at. I was comfortable, you know, if it was a game like chess where I just need to be smarter than my opponent. So if I'm playing you in chess and I have a better, you know, I'm more intelligent. I know the game better. I'm going to beat you. That's pretty much how chess goes.
So it's a little bit of that competitiveness that you have in you that started to help you look at trading as a form, as an outlet to actually apply this competitiveness,
Certainly.
right? I see.
Certainly.
So how many years back was it that you actually started to really become really interested in trading?
Yeah, so it was really while I was working for this former associate of my father's, and the best way I would describe it is I was kind of a glorified order enterer, you know, just placing things, watching positions, that kind of thing. And this gentleman was kind of a proprietary, almost like a unregistered small little hedge fund was what he was trying to do. And then I just sort of became mystified by not just what he was doing in terms of like how is this working? Like what causes something to go up? Why does this work and that not work? Why does this thing go down? And you know, a lot of it seemed random. And then, you know, you jump on a trend or all of a sudden you know, a position would work out, you make a decent amount of money in it. And his trading was even more mystifying to me because I couldn't seem to figure out how he had become successful at all because he didn't seem very disciplined. You know, we're gonna buy this and ride this trend, and then he'd jump off it, you know, for the most bizarre reasons. The end of that story, of course, is he turned out to be a fraud almost entirely. So I wound up actually reporting him to the authorities, and that was kind of how my whole, you know, entrance into the trading industry started. And from that point, it was basically, well, should I try this for myself or just start from sort of ground zero and try and find another entry level job at a completely different firm? So I scraped together, you know, a little bit of capital and then said, well, I guess I'll just try this on my own. So that was the jump off point for me.
Wow. So you didn't actually start on the right footing in any way, although you should have.
No. So ironically, I had a number of ideas that I wanted to sort of try and you know, I was working in a position like that, I got a little bit more freedom and authority to kind of do some things. And I would, you know, okay, let's try this strategy. But you know, my boss was kind of overriding me. And I remember thinking, you know, if I had my own, you know, little bit of capital to manage, I think I would do better than working for somebody else. And we were making a little bit of money, but not much, and not enough to really get excited about or to say, you know, we could really parlay this into a meaningful amount of money. And so, of course, I had no idea that, you know, there was some criminality to what this individual was actually doing. And then once I found that out, I was like, well, now I'm definitely going out on my own, or, you know, cutting all ties with this individual.
I see.
But, you know, yeah, I often joke saying I sort of started assuming when I went out on my own, I assumed that I knew less than I thought that I knew before that, because, sort of like once you realize the person you've been working with has taught you is kind of a, for lack of a better word, deceptive person, you should question everything. So, and the irony too is I sort of started with a couple of strategies that I thought were going to be successful, none of which I do or in my portfolio today.
I see. So from that point onwards until fast forward to today, where you are able to pretty consistently generate like more than 40% since inception of the fund or whichever that you are managing. So what do you think are the key turning points that help you from emptying your cup totally after this fraud incident all the way until the point today where you are considered as a very proficient and profitable trader now?
Well, for starters, I think discipline has to go with everything. So it doesn't matter what the strategy is, and the topic we'll get to later in terms of managing emotions, or what I call emotional capital, is also really a function of sort of personal discipline and how you handle those things. So I would say, obviously, I felt like I at least had a decent understanding of that. Learning a lot more, of course, as I went, but I really just didn't have much of a strategy. And then learning a number of different things. So finding a few different mentors, going to seminars, and sort of finding your own style was really important. I grafted towards individual equities, which I had actually never traded prior, because they seem to move rather quickly in some cases, and then could produce sort of this short move that was tradable in some cases, where prior I was trading more futures and options. And then, one of the things, and this is something, I credit a number of different people. Someone like my father was really good in risk management and discipline long before I even had a strategy that was really working, for lack of a better word. And then I went to a seminar by Mark Minervini, he's a market wizard as well. He's a friend of mine now. I actually do some consulting for him and for his education business, and just learning about sort of the history of studying some of the biggest winning stocks in the stock market. What really makes them go? What characteristics do they share? How do you screen for these things and identify them beforehand? So that was a big step. And then also another friend of mine he was actually in the most recent Market Wizards, Peter Brandt, who he taught me even more in terms about expected drawdowns, how to manage your win-loss relationship in such a and sizing in such a way that you have at least an idea of what your predicted drawdowns would be based upon statistics. And I actually mentioned some of these in the Momentum Masters interview as well. So those were a couple of really big sort of things. But then once I feel like every now and again, even still, you have an aha moment as a trader, as a speculator. And it can be both through winning or losing, where you start to really understand how this is not about finding one trade, or it's not about finding one good investment, and making your process kind of repeatable. And even how you use certain relationships and contexts you have with other people, where there are some people whose style is so different than mine. If they like something, I'm more apt to sell it. Where somebody else, if their analysis lines up with mine, it increases conviction. There's just so many, similar to different indicators, where for some person, an overbought indicator is a good sign, where for another trader, that's a really bad sign. So you just have to understand how a lot of different pieces fit within what it is you're doing.
I see. I'm sure you have more to talk about that later on. And I suppose you are now all ready to share your presentation with regards to how to manage your emotional capital with the summit participants. Now, to the summit participants watching this video right now, I'm sure you're just as eager as me to seek Mark's insight. So without further ado, let's sit back and learn from Mark.
Okay, guys, this is a presentation on managing your emotional capital. And as I said, or will be saying, that this is an element of trading that I think is talked about, but I want to give some practical things to think about, but also some practices that you can use regardless of your actual strategy. So I want you to think of this before even beginning as sort of an implement in a tool that you can use, whether you trade on a 1 minute time frame, whether you trade on a multi-year time frame, and whether you use charts, you use fundamentals, you use both, you use order flow, all kinds of different things. So it isn't a strategy. Think of it as an adjunct, or as I said, a really way of managing the operator of the strategy itself. So how do you continue to improve yourself as an individual, as the operator of whatever strategy you find yourself in? This is just our website. So if somebody wants to reach out there and find out more of what we do, of course, the real exciting legal disclosures. This isn't any type of a presentation to buy or sell anything, and trading involves risk. So hope you understand this is just for educational purposes. Where I wanted to start, though, is really with a completely not new concept, but original concept, at least for me, in terms of how I think of what does it take to be consistently profitable. And so I've kind of tagged this 3M theory. This is one of the first times I've actually shared this formally. Excuse me. I may publish a white paper or something like this on it, but it's just an overall theory for what does it take to actually be successful consistently over time. And what you often hear is that you have the market, and then you have my method. And I put it simply, like, so there's what I'm trading, and then there's how I'm trading. It's pretty simple concepts. And so people are trying to figure out, well, am I going to be a stock trader? Am I going to trade commodities? Now, am I going to trade cryptos? And I sort of put a list. I mean, you can trade all kinds of things, right, guys? So, and then what strategy am I going to use in whatever market I'm in? And I just sort of listed, there's quant strategies, there's, growth versus value in terms of equities, there's mean reversion, trend following, any number of different strategies. And what you often hear is, if you're not being successful, that this is, well, either the market's bad or maybe my method is bad. So it's very possible, and this is something everybody needs to understand, regardless of your strategy. So think of method as your strategy, that there will be times where that method is just not in sync with the market. If you're a trend follower and it's a choppy market, you're going to have a tough time. And the reverse is true if you're a mean reversion type trader. This shouldn't be new information, but it's really important. So one of the things that I often hear, you often hear people say, and this is something that my friend Mark Minervini regularly teaches. He says, hey, if you're having trouble, there's one of two problems. It's either the market or it's your criteria, meaning it's your method. So maybe you're just in a period where the market isn't good. And in his case, he goes, well, hey, if you have good criteria, there's only one problem. It's the market. And what I want to suggest with sort of the 3M theory is that there's a third leg to this stool that I think is underappreciated. All of us know this, but that it's possible that the market is bad if you're not, being successful or you're finding difficulty. There's another possibility, though, and that's that you are the problem or that you're bad. And now this isn't in any way to put anyone down, but it's to say that to discount the personal impact that you have specifically on your strategy is a big oversight. And so I want to suggest that it should look this. And this is kind of the basics. Okay, you've got, I nicknamed it 3M theory because it's sort of 3 M's. I've got a market, I have a method, and then there's myself. And if these three things aren't in sync, And what I mean by that is, so not only say again, you're a trend follower, not only do you need to be in market conditions that are positive for trend following, but I need to be in sync with my strategy in terms of I need to be able to identify that, have the confidence in what I'm doing, and be in a good and sound enough emotional state to take advantage. And what I've found both in trading and in teaching people how to trade is that often they are their biggest, I wouldn't say enemy, but their biggest obstacle sometimes in terms of finding consistent success. And notice this is sort of a theory on consistency. So I just think one thing anybody can do, regardless of their strategy, that I think is helpful is to sort of break it down to say, and this is generally what we should be doing in more difficult periods. Nobody does a lot of self-examination generally when everything is coming up roses, and trading is very easy. But when maybe you've gone through a period where you just haven't made much meaningful progress, or you're in a longer drawdown, having a way of asking yourself some questions. Okay, is this the market? Am I just in a period where the conditions are not suitable to my method? Then, of course, there are times and elements where you need to tweak or change your method, or it's very possible some people are using strategies that aren't in fact very good strategies. Well, if that's the case, over time, that will vet itself out, because the market tends to weed out strategies that it will reward them for a time, but then, on average over time, they will prove to not be profitable. And then, of course, am I in tune and being disciplined? Am I doing what my method actually says? One of the biggest things you hear people say is, they don't follow their own rules. This is an issue of myself, not my method. I'm amazed by how many times I hear people say, well, I bought this stock or this position at this price, and then I planned to stop out here, and then I didn't follow my plan. These are all elements in this area right here that need to be worked on and improved. And this is kind of where I'm going. This is where I want to focus on. Okay, how do we get more in tune with really our strategy? Because the market's going to do what the market's going to do. Now, that may not be in sync with your strategy, as I said before. And now, how do you get yourself in sync with your method? And this is really, getting into this concept of emotional capital. And I just put my definition is your continued confidence or ability to manage and place trades within your strategy and your process. I have a few charts, that I'm going to show that I just kind of, they aren't even as important as the idea, though, of think of your confidence as almost like an equity line. And you don't want that ideally to be whipping all over the place. Just like, I don't know too many successful managers who want their equity line moving around like a roller coaster. In the same way, you definitely don't want your emotions moving around, like a roller coaster. So what I want to go over is at least how I think about it. And keep in mind too, these are not like 10 commandment type rules I'm going to be giving. They're really more suggestions and things that I've learned that seem to be helpful to keep me in a better state for continuing within a method and a process that I know is profitable. Because even the most successful traders have moments of doubt, have moments where they're wondering, well, have I gotten lucky to this point, versus is my strategy really good, and those type of things. And I mentioned here, losses erode a trader's confidence. Doesn't matter who you are. If you lose enough, at some point you will start to feel uneasy about your trading or your investing, depending on your time frame. And then drawdowns, the longer a drawdown goes, even if it's not say meaningful in terms of its depth, can tend to erode your confidence. And so I just put at the bottom, this slide, the goal should be for you to lose confidence faster than your capital. And this is really in terms of, if you think of that 3M slide, this slide prior, where how do I get myself in sync with my method? This is something that's really important, at least for me, where I always, and I put a sort of a red, think of a red line as your confidence and your green line as your capital. If your confidence is sort of not eroding while your capital is, you're going to have a bigger problem, because you're sitting there continuing to trade, say, aggressively while you're losing money. That's a big no-no, where ideally what you want is for things to feel far worse than they actually are. And this is sort of one of the first, mental rehearsals that I'll get into. And really what this boils down to, guys, is finding some ways or questions that you can ask yourself to put yourself in a better emotional state, so that you are in sync, from what I was saying or alluding to prior, with your strategy. And one of the things when I'm in a losing period that I always ask myself is this first question: does it feel worse than it is, or is it worse than it feels? Where's reality? Because as I was saying, you may be in a period where, again, to use my example of if you're more of a trend type trader, which in some of my strategies I tend to be, and when I get into a whipsaw type market that is just, it's up 5%, down 5%, where I can't seem to get myself positioned, you sit there and you start to get sliced up a little bit. But if I'm trading small, it feels far worse than it is, because I haven't had a winning trade in what feels like weeks, but this is where, I've sort of put up Trader A and Trader B as two examples again of those two lines. The green being your capital, the red being your confidence. I would much rather, be in Trader A's camp to say my capital is just kind of moving sideways, even though my confidence is moving lower, because it tells me that once I find a little bit of success, my confidence is going to be, right back underneath sort of my capital and hitting new highs as everything is in sync and moving together. Where the guy on the right here, if you think of it in terms of he's just losing money hand over fist and his confidence isn't eroding much, I'm saying that is a far more dangerous situation to be in, especially if you're new. And so if you're new, I want to suggest that you want to lose confidence far before you lose all your money. This is why you should abandon a strategy when you're in a large drawdown before you take an account down to, say, zero, or even hearing people who take accounts negative. This only happens if you're in the wrong type of emotional state. And so I actually threw in, this is my own equity curve from the last year. I just decided, I'm a big believer in, if you're going to show slides, or it bothers me when I see people showing charts and then you ask them if they traded. Well, I just found this as an example. It's, I try any chart I show is something either from my own trading, and if I'm going to give some practical examples from some stocks I've traded in the past year as well. But this is my own equity chart in terms of equity line for the past year. And you can see each yellow dot is just a monthly point or end of the month, where I had a really nice, going back to say last summer, had a really nice run, and then went into a drawdown in February, say, of this year. Well, this is a classic example of this drawdown has felt horrible from an emotional standpoint. Just, man, nothing seems to be working. And yet I'm up for the year. I'm within a fraction of new equity highs, and really right where I should be in terms of, a normal drawdown. And if you look at this, of course, in context, which is another good question to always ask yourself, where am I in the bigger picture? Because that will hopefully put you in a better emotional state if in fact you're where you should be. But if you look at sort of, I went down here for kind of 2-3 months. in the context of a normal trend, most people would say this is normal, this is healthy. But how I was feeling in here, and even over here, was not very good. I'm sitting there going, it's been a grind. I can't seem to make any meaningful headway. But when I take a step back, run through this sort of mental rehearsal, then put everything in context, I realize this is normal. There's nothing wrong with what I'm doing. All strategies have periods where they go sideways or consolidate, just like price action would go sideways or consolidate, hopefully before another meaningful advance. So, however, what this sort of second order effect of this type of a mental rehearsal or rule for me is, if I am not feeling in an overly confident state, which is okay, I'm not, hear me clearly to say, I'm not saying you should be 100% confident in terms of how things are working all the time, because again, there will be periods where they're not working, but that needs to then be reflected in your aggressiveness or position sizing, specifically if you're a discretionary trader. But this applies regardless, because even if you're a quant trader, there's still a human being behind the quant system that has to execute that. And any quant type trader will probably tell you that as their systems go into drawdowns as well, they're going to have these type of periods. So still going through that whole process before making unnecessary changes to a strategy or to your method, figuring out, okay, am I just feeling like it's bad, or is it time to really actually look at the method, not just myself. So going through what are some other rules and sort of mental rehearsals or questions that I ask myself that I think this is more specifically if you're a discretionary or directional type trader, I think will find really helpful. The other one I use, and then I'll get into some examples. This is something I've taught to other people, and almost universally, I would say, has been beneficial. And I would say, especially if you are at least experienced enough where you found some success, or you feel like you have an understanding of your process, how you like to trade. And this is, again, regardless of time frame. And it's what I call the bother me rule. I think Peter Brandt refers to a version of this, what he calls the law of least regrets. But it's asking yourself the question of, what is going to bother me more? That's how I phrase it for myself, and for my co-portfolio manager and I. We have this type of dialogue, not daily, but pretty regularly. And we usually have it in one of two ways, but you can use this in a number of applications. But the first and most obvious is, if there's a trade you're either in or thinking about putting on that you're a little uncertain about. So maybe, and this is where being a discretionary trader, when I think of discretion, it means there's many rules of freedom, right? You hold the discretion on what you trade and how big. So those are sort of the two things. Am I going to put a trade on? And then if I put it on, how big? You can use this rule in either regard. So let's say you have uncertainty placing a trade. Should I buy this? In my case, I tend to trade more from the long side, so I'll use longs as an example, but the same type of thing follows for shorts. So if I'm unsure about buying something, it would generally be, in my case, because something doesn't meet all my criteria, but it's enough for me to be interested or to potentially put on a position. And I'm a little undecisive. I ask myself honestly, and this is one of those questions that only the individual can answer, but what's going to bother me more? Buying the position and seeing me getting stopped out, or passing on the position and then watching it having worked out without me in it? And what this tends to do is put you in a state that is, again, in sync with hopefully your method and your most recent action or trades within that method. So if you're in a really tough period, you ask yourself this question. Most people would say, I don't want to stomach another loss right now. So I'm going to wait for a better situation or setup before I recommit that capital. And what it does is then force you to be more selective, which in a tougher period is generally what you want to be doing. And I'll use this as an example recently. So in U.S. equity, sort of swing momentum markets, was pretty choppy. And this is Roblox for anybody who trades, or understands the U.S. equity markets at all, or the app markets for that much, because it seems like my kids are playing on this on their phones all the time, or my phone for that matter all the time. And this was not a very good setup. At least I was watching this name and looking for a tighter consolidation where I could buy from. And this day right here, the stock gapped up a little bit, and we went through this exact rehearsal I just discussed in my office with my co-portfolio manager. And we said, well, okay, Roblox is breaking out. It's on a gap. It wasn't very tight, but the stock has a number of criteria we like. Huge institutional accumulation, big sales. It has a pretty interesting story and theme behind it. What's going to bother us more? And we decided, well, given that things haven't been working, we don't want to get stopped out. However, if this thing just blasts off, which we think it might, we'd rather have at least a small position. And it's going to bother us more to see this 20, 30, 40% higher in a couple of weeks and us having nothing than to take a small loss. So we took some. Obviously, it worked out. There will be plenty of times it doesn't. But this example actually leads then into the other case in point we often use it. So this is a case where it's either, am I going to buy anything or nothing? Well, going through this rehearsal put me in a position. Now, keep in mind, of course, you have to be honest with yourself when you're going through this. So if you're just a gambling junkie, you just want the action all the time, your answer is always going to be, well, I just want to buy because, I just want to be in the next trade. So with this will come a little bit of maturity, hopefully, as well. But, back to this slide, think of it then for a more picturesque or picture perfect textbook setup for you. One where you're going to take a position. Now the question becomes, how should I size this? Well, you can use the exact same rule. The same logic applies. What's going to bother me more? Putting on this position in a textbook type setup and only having minimal size, or having my maximum allotted, say, position sizing. And so I'll go through another example. This is Pinterest from last year, and it set up in my mind what was really kind of textbook, because you had, I won't get into the overall technicals, but we had a really nice uptrend. And if I had it on a weekly as well, you could see the stock was, under really large accumulation, met basically all my criteria. It even put it in a nice shakeout. And I was looking at the stock right over here, and, we just said, okay, we're going in guns blazing. Biggest size, biggest position. It went considerably higher even than what I have here on the chart. But I only got there because I went through the process to say, okay, here we've got a really good setup, something that I really like. It meets all the criteria. And this is a newer issue, which is something I also, newer meaning in the last couple of years, something I tend to favor because they're less followed, which means they can have bigger alpha moves. And again, it was just checking all the boxes. It was going to bother me more to buy this and have it work out on just say an average size position. I wanted to be overweight. Well, I only got there because I knew, and some traders know the feeling of, yeah, I really nailed this trade, but I didn't have enough on. Now, there will always be an element to the fact that you never have enough of the good ones, as the saying goes. You always want more of the winners and less of the losers. But again, running through this type of mental rehearsal, I think will put you in a better position, especially as you improve within your method. So if you're just, again, this applies more to discretionary traders, but as you start to really refine what you're doing and seeing that, if I see this type of setup again, or if I see this combination of variables again, you're going to know It's going to bother me a lot more to see this again and not take full advantage. So, sorry, here. Back to the slides. And one of the things then I often say gets me to the place that allows me, say, to put on, say, bigger sizing is then coming or keeping me calm and cool emotionally while I'm in a trade is developing some leading and lagging indicators. And this is really nothing new. It's just sort of the way I think about it, because we all generally understand, or I hope you understand at least why you're buying something, or at least why you thought you were buying something. But what's going to keep you in the trade, say, after you put it on, or to my point earlier, where we don't know nobody knows, by the way, what's going to happen after they buy something or sell something. If you get into a position, we're sort of at the whim of the market. So developing some things that will then sort of increase, that emotional capital or your confidence in the position or in what you're doing is key. And how many times have you heard somebody say, well, I bought it right and I just didn't stick with it? Or I bought the stock at 50 perfectly, and now the stock's at 100 and they sold it at 51 because they got shaken out of the position for some other reason. So having some other indicators that are a part of your process should increase your confidence within what you're doing. And again, guys, you're the one managing this stuff. So you think of it in terms of what is going to give the operator more confidence in the machine that they're running. If you think of your method as sort of the machine, you're the operator behind the wheel. So yeah, I just kind of put here, you should always be looking for ways in which to increase their conviction before placing the trade, and then once you're in it in terms of sticking with it. So thinking of leading indicators, just what leads me to the trade. This can be a variety of things. I put a couple of different examples here, but it's almost endless in terms of the number of things I've heard people use in terms of what are they using. Sorry, I got a little bit ahead of myself to lead them to stuff. Charts, fundamentals, technicals. I know some guys like to watch just the price action themselves. I've seen and heard other guys that they're just looking at, say, volume profiles or certain order flow things. And then, some of the things I use, unique fundamental stories, contrarian sentiment, those are a few. But whatever brings you into the trade, the more of those things align, you should have more confidence in terms of that position. To my point before, say, about an example like Pinterest, where you're potentially putting on, ideally, what's your maximum size, say, within your risk management. This is an example I've used in the past for where I nailed leading indicators, and what led me, and those prior examples, say from Roblox and Pinterest, would just be overall how I look at things. But this was a smaller stock I traded years ago, and the little blue arrows are where I bought, the little red arrows are where I sold, and it looks like a great trade. It was a great trade, and I happened to be at one of Mark Minervini's seminars where David Ryan, who's another market wizard and somebody who's taught me a lot, was a guest lecturer. He afterward asked me, "Hey, Mark, did you notice all that volume that came in after you were buying?" And I said, "Well, sure, I guess I noticed it, but he said that this actually met one of my rules to automatically hold the position for a bigger move." And I said, "Well, I didn't know this rule, so teach it to me." And so he kind of went over what he calls his MVP criteria, which is just simply a stock goes up, I think 12 out of 15 days, say, after you purchase it, and then on average, say 25% above average volume in that period of time. Well, often I was selling positions before they even got to that 15-day window. Well, here's where here's my arrows over here from where I bought and where I sold, and listen, you can always sit there and kick yourself to say, well, I coulda, woulda, shoulda, and play Monday morning quarterback. But in this case, the market was telling me something, at least to potentially stick with a little bit of the trade. And so I took that and added that sort of to my quiver to say, once I'm in and I see X, Y, Z, this should increase my confidence, at least to stick with a portion. And this is really something that, you know, I call it a lagging indicator, because you've already bought the thing or sold it. What can you develop, or what have you noticed that is a meaningful indicator to increase your confidence of sticking with a position? And these are some of the ones that I use. One of the best examples for me is when I get strong follow through, and that was sort of the point David was sort of teaching me at the time. I was still new at this, to say, listen, you had strong follow through and big volume. That is institutions that are potentially starting new positions. So this is at the beginning potentially of a maybe a large trend rather than the end. And you know, I put some other. These are some I use, but here's what I would say. When it comes to specifically these type of lagging indicators or indicators from your own trading, I have heard from many people that are directional traders to say one of the best indicators of success for them is that they're at a profit right away, meaning they've timed the trade perfectly. This can, again, be either on the short or the long side. And so I put it here, sort of immediate follow through or no pressure. If you're under no pressure, your confidence, ideally in that trade, should be running high, because you stepped in, timed it perfectly, and took no heat whatsoever. So these are just some ones I use, and then I added an example where, at least for me, this doesn't happen often, but all the pieces kind of came together. So remember, I like to look at technicals and fundamentals. And then I also like to understand sort of the groups and the story to bring me into the trade. And then occasionally I get, you know, so sort of those overweight type positions. And then I get the really, you know, that tell me time to put on a say your full type size or an overweight type size. Then I get, after you get in the trade, things start really working. And it can really combine, at least for me, for a much more powerful situation, because I'm not trading everything necessarily uniform size, because I'm using my method and process to dictate that. And then again, the lagging indicator kicks in and says, okay, this is one you want to stick with. This isn't one you want to trim too early. This was a U.S. multi-state operator in the marijuana space last year, that right here, for me, this would be a normal, really nice setup, had a nice little cup and handle. I understood the story really well. I liked the price action. I liked the volume. Everything that would lead me into it said, okay, this is working. And then here's that same rule from that PATK example. You know, I buy the name coming out of this cup and handle right over here, and you've got 12 out of 15 days up, really big volume. Well, I put in a rule, and I was kind of at a profit right away as well. I have a rule saying, if I see that again, it's an automatic 4 to 6 week hold. Where normally I would take a tight stop in here and sell at a 3 or 4 to 1. I sold more than half my position into this run here, and then used the trailing. I kind of institute a rule. I'm going to use a 4 to 6 week hold, and then I'll even use like a 10-week moving average or a 50-day moving average, and I use the 10-week, sort of closing below for the remaining position, and wound up making probably 5 times more than I otherwise would have, say, on a more routine situation. So these are just some examples. Again, this isn't bound by strategy at all. So if you're a quantitative trader and you're wondering, should I start tweaking my signals, I would say run through some of these rehearsals, at least the prior ones. If you are a discretionary trader, then I think there's definitely value in some of the things that I'm talking about, in terms of asking yourself regularly and routinely in terms of, am I in check with what I'm doing? And if you're a beginner, just sort of to close, if you don't have, you're not going to have as much confidence when you're starting out. Engaging your ability to be consistent and follow your own rules and why are you tempted to potentially deviate from your own rules, I think you'll find that it's for emotional reasons. So if you think about why does anybody not want to take a predetermined loss? This has always mystified me. And it wasn't until you realize that the reason someone says, well, I'm going to buy a stock at 10, and if I'm wrong, I'll stop myself out at 9. Why don't they follow that rule? It tends to be because of emotional reasons. So I would just encourage you, wherever you're at in your journey, start asking yourself some of the harder questions. Why am I doing this? If you're breaking rules and you're new specifically, you really have to start asking yourself. Because if you're breaking rules, pretty soon you don't even have any rules, because rules are supposed to be there to keep you from breaking them. So I hope this has been helpful. We'll get into Q&A. This is just a quick, if anybody wants, I'm doing a guest lecture at this year's Master Trader program, which is online, and one of the few benefits of COVID, of course, just like this event, it's great because we can get traders from all around the world together and connecting online. Or you can reach out again through our website. So thanks for the time.
Hey, Mark, that was really an insightful presentation that you have done for us. I'm sure the summit participants now have a better understanding of how to actually manage their emotions when implementing their trading plan. Now, to help the participants clarify some of those points that you brought out earlier on, shall we head into the Q&A segment now?
Sure.
All right, so at the very start of your presentation earlier on, you actually show us this chart showing the level of your confidence versus the level of your equity. And you suggested that the more ideal scenario is to allow your confidence to go lower faster relative to your equity. So can you share with us some real life situations that you have experienced before in where your confidence actually plunged lower and faster than your equity, and how do you actually recover from that situation?
Sure. And I shared the equity chart, from my own account in terms of at least the equity line as an example, because even though the drawdown looks, not very ominous, I was feeling far worse about it. And this is a question I've posed to other managers who've been doing this a lot longer than I have. And I've often posed it this way. Do you want things to feel worse than they actually are? And almost to a person, all of them have said absolutely. Meaning, if it's sort of like if you and I get into an absolute brawl with each other, and I feel like you have just beaten the crap out of me, but then I look in the mirror and I don't have a scratch on me. The reality is I got out of that terrible situation fairly unscathed, even though I feel like I have been nearly killed, and why is this important? Because your capital is fully intact. And this is the point I was trying to make is you're going to get in big trouble when you're just continuing to be, generally this reflects itself in position sizing, Philip, right? So when you're confident, ideally you should be expressing that via larger trades or more exposure, depending upon how you look at it, where if this will naturally make your drawdowns smaller because you're gonna reduce your sizing the minute you start to feel right. When I feel like this doesn't feel good, I'm not getting the feedback I'm looking for in terms of the market, which is making me feel uneasy, which is then forcing me to shrink my size.
I see. So does that mean that in a way when you are starting to see a few losing trades are starting to get a drawdown, you just purposely try to hit yourself down to make you feel really lousy in a way, or did it just come naturally to you to feel lousy?
Yeah. So yeah, that's a really good question. It's the latter. Keep in mind that obviously there are lots of things that can drive our emotions. This is another reason why many people have said over the years, say, if you have major personal problems going on in your life, you shouldn't be trading, or if you're not getting enough sleep, or these type of things, because there's a whole lot of reasons you could feel lousy. Let me be clear about that don't have anything to do with your trading. But this is why, and I I think it was Paul Tudor Jones or some really famous hedge fund manager say that when I have heard someone say is going through a divorce, I redeem money immediately, or he basically puts someone in a timeout. Well, why would anyone do that? Because he knows they're not going to be in their normal emotional state potentially to be in sync in a way they should be with their own strategy. That was sort of my point of the triangle early on. If you don't see yourself as being a integral part of how these things work together, you're going to have a problem. But you're absolutely right. There are all host of reasons why you could feel crappy independent of your actual trading. But the idea is if you're in sync, the reason you're not feeling well is because your trading is not going well. The market is telling you, especially if you're a discretionary trader, that the market is not right for what you're doing. So you need to respond to that. Again, it tends to be a reflexive response. Market isn't aligned with my method. Things aren't working. And all of a sudden, I'm feeling immediately like my timing is off. So I shrink my size. Maybe I step out completely and I just wait.
I see. So you showed your equity curve just now. I mean, you for the past year, you actually went up almost 170% and you draw down to 140%. To a lot of people, they will be thinking that, wow, I'm still up 140%. They'll be feeling so good about it. Yet you beat yourself down because of that particular drawdown. So what do you actually try to do during those periods when you are at a high of 170 and going down to 140? Do you simply just trade less? Do you actually just size smaller, or do you actually try to change your trading style or methodology in any way? Or do you continue to trade as per normal but with just smaller size? Can you think back to that point in time when you had that 170 to 140 drawdown? What were the concrete actions that you take to rebuild your confidence or when the swing comes back in?
Sure, it's both. To the short answer, you said, do you trade smaller or trade less? It's usually both for me, and often my biggest drawdowns like that, they tend to be after really good runs. So in some cases, that's normal, especially if you're trading directionally, either from the long or the short side, you're going to have some open trade equity give backs along the way. Any type of trend follower, whether your time frame is very short to very long, in order to stay in those trends. So then the question becomes, okay, what's normal versus what's abnormal? I didn't put that on as a formal question, but that's one I ask myself on the regular as well. Is this normal? So in that case, I had the largest give back in terms of open trade equity in probably more than a year. Now, to your point, I'm still up month over month and over the previous trailing. You're never going to print green numbers or black numbers every single month. And I know if I'm in a strong period where things are really working, at some point I'm going to run in to the opposite side of that trade. So I'm looking for what's abnormal. So, and some of this is intuitive feel, but meaning, okay, if I'm seeing either a certain number of positions stop me out in a certain window, or a certain amount of pressure in terms of P&L, in terms of percentage in a certain time, that is going to automatically then either have me raise stops, trim positions automatically, and I use both. So sometimes I have like some, almost think of it in terms of portfolio risk points to say, if we're down this much, we're cutting. Now then, once I'm in a period where I've pulled off the highs and I'm in a consolidation, I'm much more cautious. Now, some of that, again, is because I'm not feeling as confident as I was when you're in that nice, strong uptrend. So I will start off even more conservatively. So let's say I have a period where I'm heavily invested, and this is exactly how it worked earlier this year. I was extremely long and then went almost to complete cash where I was in that troughing period. Well, when I step back in the market, I'm not stepping back in fully invested. I'm starting very small because I want to stay in that consolidation. And as my confidence in my timing with the overall market is not in sync. So I'm waiting for things to get in sync, and then I'm going to get more aggressive. So ideally, my confidence and my capital, everything is hitting new highs all at the same time and sort of stepping on the gas at the right time.
I see, I see. So how about situations where, let's say, for example, there was a period in time, I think the year before, that the market had a very sharp fall, and then after that, it came up very sharply thereafter. How do you handle your emotions in such kind of market conditions?
Sure. The 2020, I mean, it was a crash, for all intents and purposes, at least, in the US in terms of the speed of that decline was one of the biggest in history.
Yeah, you
Uh,
wouldn't have time to actually build up your emotions and go aggressive again because you will totally have missed the boat. How do you handle that?
well, and so in my case, I tend to try and sit out those big slides or be in as much cash as possible. Keep in mind, though, Philip, in terms of the overall discussion, maybe you're a volatility trader. So, prior to that, might have been tough trading because you didn't have much volatility. Then all of a sudden, it was it was just Christmas for volatility traders. So it applies to any strategy. In that case, though, for somebody, I tend to trade more on the long side and then sit out in periods where there's either really high volatility or I'm just not seeing much progress. Well, for me, it was really a function of I went to cash before things got really nasty. And this is where, think of it, I always say that every large decline starts as a small one. So every crash starts as a 5% pullback and then a 10% correction. And if you looked at how last February into March unfolded, you were right. It was really it was down and back. I mean, it took a lot longer to come back, but we went down in 3 weeks. The 3-4 weeks was the worst of it. Well, if you're in cash by week one, in some ways, those declines actually increase your confidence, because when you step out of the way and then a bus comes and runs over the next guy, you're thinking, my goodness, thank goodness I got out of the way. And that has happened to me many times in my career where, again, taking small losses has always helped me avoid the huge ones.
I see, I see. All right, so I just want to use the equity curve that you provided as a base to discuss about the way you trade. So in order to actually generate in 170% in a year and having only a minor drawdown, so I would like to explore a little bit about from what I see, I think it's really unlikely if you don't use leverage, you can't generate that kind of returns, right? So was leverage a very big part of how you were able to achieve 170%? What are some of the factors that allow you to generate that kind of returns in a single year?
Sure. Well, listen, here's the funny thing about big returns are going to be a function of a couple of things. It doesn't have to be excessive leverage. I did use some leverage, but there were times where I wasn't leveraged at all. So I think of leverage as a tool like anything else. It can be valuable at the right times, or think of leverage in terms of like putting something into overdrive, or if you've got a sports car and you've got a sixth gear, you only do that when you're on a straightaway and the road is smooth. But yes, I will use leverage when things are really working. And for me, that usually means, so, in terms of equities, if I'm, 100%, I usually don't get more than, say, 2 or 3 times long. So 200 to 300% long the market. But the other thing, though, is timing. The only way you can get aggressively long and levered is if you're confident in your timing. So to my point earlier, if my confidence is really riding high, I know it's going to bother me more not to have on as much as I'm comfortable having on based upon my overall, strategy and risk plan. But I don't know if that helps, but generally, if you're going to put up really big returns, and my returns are often, they tend to be like that chart. I go on a run and then I try and put in a base, and then I go on a run and sometimes I might chop around in that base for a little while. My goal is to keep things because I'm really looking for everything again to kind of be in sync before getting really aggressive. And so, even for me, I would say, yeah, I've had some triple digit years, but then I've had some years where you just kind of bide time, So even the best traders you say things like, well, so-and-so made 50% annualized. They didn't just do 50, 50, 50, 50 generally. They made money in bunches, and then, just like any other appreciating asset.
I see. So generally, I personally realize that confidence are not affected only by the way your equity move. Sometimes it can be affected by how the sector is actually performing, how the actual broad market is actually performing, or how intermarkets are actually performing. So how do you actually go about handling the confidence level? Let's say, for example, you see this particular stock, while it has come down a lot, it has built up a very strong base, and it has just broken out from a very, very nice base. But at the same time, the sector doesn't look like it's performing very well, or the broad market looks like it's in a correction mode. So how does all of this plays into your confidence of taking that particular trade that shows you all the best indication that you should actually be getting in? Do you actually decide not to take the trade, or do you actually adjust your position sizing as well?
This is exactly to the point, again, from the slide about leading indicators. So the more sort of boxes it checks for me, the more confident I'm going to be in it. Now, that could be the group, it can be the general market, it can be the specific technical setup or the fundamentals in that individual stock. Those are all just a couple of things. The more of them the more stars aligned, the more confident, of course, I'm going to be. Now,
the more likely you are to take the trade, and the bigger the size you are likely to take as well, is it?
Absolutely. Now, the size will depend on two things. Three. Liquidity, one. If it's not a very liquid situation, I'm not putting on a big size. Two being everything we just described, and then the other one is how things have been going. Meaning, how are my overall trading feeling? I want to be trading my biggest when I'm the most confident. So if my last 5 trades have been stopping me out, I can promise you my 6th trade is not going to be huge. It's just not. I use the example of, say, Pinterest. If I had showed you the last 10 trades, 8 out of 10 of them are probably winners. Then I see a really good setup. Now I'm going in big.
I see. All right. So during your presentation earlier on, there was this particular part you actually mentioned, less followed stocks more likely to have a higher alpha move. Can you explain what do you mean by this?
Did you say less volatile?
Less stocks that are less followed. I was
less followed. Oh, sorry. Yes, less followed. Yes. Absolutely. Well, think of it, and this was sort of in my own maturation process. A big thing that I've learned, and that is, if you are trading directionally, and what I mean by that is, I'm not buying something and then selling something else against it. I'm taking a pure directional bet on something. Inefficient pricing is what you want. And what I mean by that is, because if the more efficient something is, the less likely it is to move, because it's got everybody else holding it in line. And think of it in terms of equities. This is any market though. From bonds to cryptos to equities, you name it, the more eyes and more people following it, there are more people that are trading it from both sides that are holding in a line, the less likely it is going to be to have a really quick or strong move in one direction. Why? Because there's always somebody there taking the other side. Now, I'm not saying just go find something that trades, 100 shares a day, that's so illiquid that you can't move it, but there's a really healthy balance in there. So what I mean by less followed, specifically in equities, is these are stocks that maybe they have 1 or 2 analysts that follow it, and that analyst probably isn't really following. He doesn't know the company all that well. It's smaller market cap, a little bit lower float. If you time those right, they can be really powerful situations. Think of every year, if you look at what were the highest, say, percent advancers for the year, and this is in any stock market, not just the United States. I will bet you they are probably in the smaller cap areas where there's something powerful going on. Maybe they have a catalyst. It's a new product, a new CEO. Some of these have been talked about in William O'Neill's books and Mark Minervini's books. This is talking about growth stocks specifically. So I would much rather trade even an average technical setup in a smaller mid cap name than a perfect setup in a blue chip name. Does that make sense? Because that blue chip name just has, I mean, they literally if you think of a Dow stock, probably has thousands of people who are paid just to watch that stock and to cover every little bit of it. And then compare that with all these other smaller stocks where no one's paid to watch them. And someone like me, maybe the only person watching it in this minute, in this moment, there's just a lot more opportunity there.
I see. So to just elaborate a little bit about that point, of course, we are actually getting a little bit into the strategy, which I think that since you're already here, it makes sense that we try to talk a little bit about strategy as well. So you mentioned that, okay, a stock that is not being noticed by many people, they are not in the news, very few analysts covering it. But of course, that the downside is, of course, that even if you see that it's a viable trade, it looks like it's starting to move, it could actually take a long time for people to actually realize about this particular stock and before it starts to move. So does that mean that when you enter a trade of, like, let's say a small cap stock, and after a while it still doesn't move, or maybe the initial move happened, but after that it just continue to go sideways or just go nowhere, do you actually have a time stop to get out of a trade when that happens?
Sometimes I'll use a time stop. The shorter the time, so the more precise I am on the timing, meaning where I have a feeling about an expected move, the more likely I am to use a time stop. So if I feel like this stock should break out in the next day or two and it doesn't, I might just step aside. Now, I might get back in if it breaks out. And sometimes I'll do that maybe even multiple times in a row in a single trade. Where I'm just expecting a position to go and it won't. To your point, maybe something has broken out. It's worked a little bit, but hasn't gone as, what do you do? Then I might move a stop up. I still may use a time stop. Most likely though, if it isn't doing anything wrong, meaning the stock hasn't made any major stumbles or some type of a violation, it's not taking out, say, a key moving average on volume, or then I'll try and give it the benefit of the doubt. But usually then I don't want to take a loss. So I'm still trying to trade ahead of where I got in, assuming I'm up on a position. And then some of this is a function of time frame. So if I make the decision based upon a stock that I'm going to hold a piece of the name for a bigger move, then I'm even more forgiving. But again, that is assuming that I'm already at break even or better. So I'm playing in an advantaged position to try and stick with it. And if you're going to play anything for a bigger move, you're going to have periods where you, like you just described. And this is where, sticking to your plan, asking yourself, why am I potentially overriding my plan? I said I was going to do this. Why aren't I sticking to it? And then having rules, of course, well, there's a reason why you're not sticking to your original plan. The stock did this and I did, that's a part of my rules now. So I don't know if that helps, but that's how I think about it.
Definitely. So if that's the case, after you get into a trade, do you typically try to add on more positions if it's like working out well? And what do you do also if, let's say, the price starts to go parabolic? Do you actually take your exits earlier and stuff like that?
So, well, again, ideally, some of these are in place beforehand. But anytime things are working, I want to try and be more aggressive. Now that can be in terms of the position I'm already in. So let's say I buy something, I like the way it's acting, and I can add more at a low risk entry. So I don't just add more. Let's say I buy a stock today and it moves 5% higher and I want to play it for a bigger move. I'm not going to add more because it's now extended from wherever it was I was buying. That was probably good timing, but I may buy more 5 days from now. If it consolidates, yeah. And, we have to get more into the weeds in terms of exactly how I do that. But I'm always looking to bump up my exposure. So if I buy 1 or 2 names and they both blast off, I'm more likely then to buy 2, 3 more names rather than the same name, because those are already now kind of extended. I'm trying to remember what the second question you asked was.
Do you try to take profits at the top? Or do you actually use more of a trailing stop?
Both. If something gets, you use the word parabolic, then I definitely want to sell at least a piece into that run, because the nature of any type of parabolic advance is it's unsustainable. So at least in the short run. So I would rather peel some off. If it's really strong though, and I'm in something for longer term, I am more likely to try and hold a piece of what I think is a really powerful situation, which means I'm going to give some back off the top. But that's the price you're going to pay to try and play for a bigger move. But I should say, I never though will put on a large position and then ride it all the way through to a trailing stop. I'm always trying to smoothen my equity curve by selling at least portions as that gets extended.
I see, I see. All right, Mark, you also mentioned that position sizing is actually one of the very important element in terms of helping you manage your emotions, especially when you're in a drawdown and stuff like that. So can you share a little bit about the general guideline that you use when you do position sizing or risk management for yourself? Let's say, for example, when in two different drastically situation that you're in a drawdown, how do you actually go about sizing trades for yourself? And when you are very confident, what is the kind of sizing that you typically use for yourself?
So if we're talking about equity specific, but I'll talk more in terms of, percent risk to your overall, percent risk to your overall account, because that's more helpful for people.
Yep.
If again, in terms of confidence, I will go anywhere from say 1/4% being on the small side, up to as much as 1.5 to 2% per position.
A position, okay.
But I'm not gonna. Again, so let's say I want to put on a really big risk to my overall account. I'm gonna tend to layer that in. So I'm not gonna go, or I'm gonna do it one of two ways to say, either if it's an individual position, I'm not just gonna come in right off the hop, guns blazing. I'm going to put on little bits, and then if I think my timing is really right, I will add, sort of that, really stomp on the gas on the last piece, or then I will do it because sometimes my positions are very correlated. So I also have to be mindful of that. Where if I may have 5 positions on, but they all are risking 0.5%, I may have 2.5, 3% risk right there. So it's a balancing act between those two things. But but the same rule applies, meaning I'm only going to be increasing as things are working. So if I have a nice cushion and then everything stops me out, back to that point before we looked at my equity graph, I'm still just going sideways. So because I've layered in such a way then where if I get hit on everything, I'm trying not to make new lows there. It's like I'm treating the market in terms of or my feedback as until I can sort of get some escape velocity. I want to keep those hits to a minimum. So I generally this is how, like I said, in any period where things are not working as well, I'm going to start in that 0.5% risk category. Well, you can take a lot of 0.5% losses before you rack up any meaningful drawdown. And I've gone to the point too where then I don't even take any more trades for a while. I just watch a few, and then I might go back and take 1/4% or 0.5%. I would rather see something work out on paper. If I've been stopped out, I mean, I've had periods where I think I've been stopped out 15, 20 times in a row. Well, if you're taking 2% losses on each one of those, that is a nasty drawdown. Right, where it's to the point where I'm almost so as it comes down, it gets, it almost gets flatter and flatter.
I see. All right. So, Mark, you are famously known as a momentum master, right? Can you share a little bit more about what does that constitute to be a momentum trader in your perspective?
Well, it's just trading extreme strength or weakness would be the best way. I prefer the strength. I think, momentum situations are just where the market is signaling something is going on. And the price action is often getting ahead of the fundamental picture, and people the market isn't fully discounting all the relevant information. And sometimes I don't even know all the relevant information. I'm just trading on a price action type basis, or sometimes those momentum setups then often signal that there's a much larger either theme in that one stock or one area. For me, especially early on, I look at momentum as these are good trading situations, not generally investing. And the reason is because when that momentum breaks the other way, it can be it can be just as violent in the opposite direction. So there are also situations where you often know if your timing is right very quickly. So you can use your capital more efficiently. You turn your edge over more. Where I love getting stopped out in one day because it's on to the next thing. My money's not tied up in something, where I'm waiting months, to be proven right or wrong. Now I'll have situations, like I said, where I'll ride position. That's a completely different type of setup than pure momentum. So that's really how I think about it. It's just a really good opportunity to potentially catch some alpha very quickly.
I see. Hey, Mark, as a conclusion to our session today, can you just bring out that 2 or 3 very, very important areas that any traders should be focused on if they want to be able to have their emotions contained so that they will stand the best chance of becoming a profitable trader? Just to summarize that 2 to 3 main points, what would be the most important thing you want the summit participants to bring back with them?
Sure. Well, the first is, like I said, if you're not asking yourself questions on any level, I think you're asking for trouble at some point, because there are going to be times where your confidence wanes in what you're doing. So to have some routines that you can go through, and the ones I gave those are good suggestions. Those are ones that have been effective for me and for some other people. Like I said, these aren't golden rules or commandments. But to be honest with yourself is really important. To be willing to examine yourself, and what some people find when they do that is that it actually helps them even make small changes to their strategy, their method, because they realize, I'm just not comfortable playing for really big moves. I like the shorter move. Why? Because that's just more fits who I am emotionally, because it drives me crazy to give back all these big open trade profits. Well, that's okay, but you're only going to discover that if you're willing to sort of be honest with yourself. And this really comes back to, the risk management piece. Risk management and emotions have to be, they're linked very strongly. So yeah, I would say, first and foremost is risk management, but then emotional control. So all of these are to help people understand that you have to be in control and in a good emotional state in order to be successful. Again, just to encourage people that there isn't just one way, but you're going to have to find some of these that work for you. So to encourage people, be honest with themselves, ask themselves regularly, how am I feeling about this? And we didn't even get in, Philip, to if I'm massively overconfident, that's on I was more on the protective side, making sure that you're protecting your capital. And this is, this is really some of the more interesting parts of trading. Trading is a reflection of who we are as individuals. Well,
Fantastic. All right. Hey, Mark, this has been a really fruitful session for me, and I'm sure the summit participants benefited greatly from your sharing as well. So thanks again so much for your participation in this summit.
Philip, this was great. Thanks for having me.
All right, so for those of you watching this summit video right now, if you would like to keep in touch with Mark and check out the upcoming trading course that he will be a guest trainer on, remember to click on the web link provided below this summit video to learn more. And finally, if you would like to review Mark's summit video beyond this summit, you can also check out our TraderWave TV service, which is in short, the Netflix for trading education. With that, we have come to the end of this presentation. I'm your summit host, Philip Teo, and I hope you will continue to learn and apply the teachings from the many wonderful speakers on board this virtual summit. Take care, and we talk soon.